Uh-oh. All right. Good afternoon, everyone. Good afternoon. How are you,
Good
Sunshine?
afternoon.
Good afternoon. Good afternoon. How are you, Rostam? Oh, Rostam, that was okay. Thank you for reminding me. I thought I was trying to make myself a moderator. Hold on. Yeah. Well, happy Thursday. Okay. All right. Happy Thursday, Zainab. How are you? How's everybody? All right. So we are okay. Group of six. I guess. Uh, Very good, Zania. We are gaining. I guess we are gaining more people. I mean, as we go along, we'll be gaining more people. Six. 6 men or 6 people strong. That's you don't have to have a large pool of people. It's always a few good men, a few good people that will change the world. All right. So yesterday we stopped uh, right here at this model, which is basically uh, Excel's built-in function, right? It is Excel's built-in function for built-in command for price, bond price, and uh, bond yield, finding bond price and bond yield. But again, um, you need to use this function. You need to revise or you need to revise or reset the format, right? Reset the model format because uh, price price data is now not actual price, not actual price number, right? It's percentage now. Although there is a dollar sign here, ignore the dollar sign because face value is entered as percentage of, I mean, this price is entered as the percentage of the face value. Face value is $1,000, and that's 100% of $1,000 face value. So all the prices are basically expressed as percentage of the face value, right? And then uh, we need to have time zero and maturity, right? We need to have calendar dates of time zero. In other words, the uh, purchase date of the bond, right? And the maturity. Of course, uh, it is called, purchase date is actually in the Excel's command, in the Excel's, formula, right? It's not formula, actually, it's a function, right? Excel's built-in function. Uh, it's called the settlement date, right? Settlement. This is maturity, of course. And I explained what settlement is. Settlement is, literally, settling the transaction, right? That means you made the payment. If you settle the transaction, that means if you have settled the transaction, what does that mean? It simply means you made the payment, right? So with that in mind, and let me also open that. Let me also open this so that you know what I'm talking about. Okay, so here in our example, consider a 15-year bond with coupon rate of 5.5% paid semi-annually. And the prevailing market rate or the interest rate is 6.5, priced at 940. Should you buy this bond? So this bond, that means this bond is actually, uh, that's not the rational price. That's not the intrinsic value or fair value of the bond. It's just the market price. So we need to know whether this is overpriced or underpriced. That's the point. I mean, any asset, think about it, anything that is overvalued, stay away. Isn't that right? And anything that is undervalued, that's the buy target, right? Anything that's overvalued, that's a sell target. Of course, to sell, you have to already own it. But even if you don't own it, you can still sell in the financial market because there's something called a short sell. Short sell. You can sell something short, meaning you don't have it, but you can borrow from the broker. You can borrow the asset from the broker and sell when the price is high because it is overvalued. It is high, and because it is overvalued, there will be a correction. Correction will bring it to the a rational price, and then you buy it back because you borrowed the asset, so you owe it to the broker. You have to return it to the broker. So you have the obligation to return it, so you have to buy it back. But think about it. You sold it already when the price was overvalued. So when you are buying back, you're paying lower price than what you sold it for. So you made money, right? This is short sale, right? So let's see if this is okay. Let's see if this is a good buy or not. Or I mean, this is so we did that in the video, right? $100 coupon, 100% of $1,000, right? 100% of $1,000. Coupon rate of 5.5. Of course, you should know by now that all the bonds are semi-annual, so M is 2, right? Payment 2.75. Time left, time to maturity 15 years. So total number of coupon payments or compounding 30. 6.5% APR or market prevailing market rate. So if you calculate the rational price of the bond, it is $905.10. So what do you say? This is overvalued. So it's not a good buy, right? We can make that evaluation. We can do that evaluation. So let's continue with the remaining part of the video.
So once again, this is percentage price, not the dollar price. So this means 90.51% of $1,000, 90.51%. So in dollars, that's going to be $905.10. Now here, yield, we can find yield when we know the future value and the current market price. So again, then we go to Excel's built-in function, scroll down to yield. Yeah, there is yield. Hit OK, and give it what it's asking for. Settlement. This is the settlement date. Maturity. This is the maturity date. Coupon rate, and then this is price, right? Current market price. Redemption. Okay. Frequency. Very well. I already gave you something here. Okay, 4.53%, right? So actually, this example, these are actually now replicated example from replicated, same example replicated from above. Actually, look, this example, I solved it using rate, right? Or rate function, use it, and I entered price as negative, right? Because it's cash outflow. I got this. it's just because 2 times this, right? So, and this one is actually, where did I have it? Oh, maybe I didn't. I used a. I didn't do this example using. I did. I just I'm using this file as in pristine state. In other words, we worked on this file last time in one of the last lectures, but I didn't save it at the time. I definitely did this example somewhere up there, but not in this setting, right? But I didn't save it, so this file is in the starting all from the scratch. Anyway, so that's how you use yield function and price function, right? All right, so that's it for today. I'm gonna see you in the next video. Okay, next class.
Okay, we're gonna also do
end of video.
We're gonna also do the Excel exercise of these examples, right? And okay, so let's move on to the next video, right? And I'm gonna have to do it from separate here. And so next, so we are finally going onto the last video file.
So risk.
Okay, let me just make sure that video number 4. Yeah, let's put
this.
Okay, so now the next topic, next section is interest rate risk.
Okay, so in our last class we discussed the strategy to maximize your bond return with the interest rate forecast, right? In other words, remember this, because the interest rate forecast is relatively available. I mean, because at least Federal Reserve is constantly providing guidance as to where the interest rate will be going in the near future, at least in the short run, right? Short run meaning 1 year at most. So at least you get the a pretty good sense of where the interest rate will be going, and based on that, you can build your strategy, because we know there's an inverse relationship between the interest rate and the bond price, and also, but then interest rate is, although Federal Reserve is constantly trying to keep the interest rate on target, right, through the bond market operation, but sometimes the unexpected events can cause change in interest rates, such as you remember even before March this year, right, before the explosion of the pandemic, right?
So that was March. Reference year here is 2020, right?
Actually, the economy was very good. Economy and the stock market was booming. So the Federal Reserve was actually on the path to raising interest rate. I mean, even early January of 2000 this year, 2020, the Fed funds rate was near like 2.5, 2.75, and then around as this outbreak of coronavirus in China, and then spreading, they spread across the world, by March, right? I mean, so slowly, Federal Reserve started to lower the interest rates. And by around March 19th, I guess that was, if I remember correctly, the stock market made a nosedive, right? It just plummeted with a nosedive. And the market lost almost about, like close to 30% in just one day. And then, at that point, the Federal Reserve, accelerated. They really sped up the interest rate drop, interest rate drop. So interest rate is now, from before the early this year, before the outbreak of the pandemic, Fed funds rate was, slowly going down. So it was, near like, 1 point something, 1.5, and then after that it's 0. But think about it. This type of drastic event is totally unpredicted, because this event is, non-economic. It has nothing to do with the economics. I mean, the origin of this crisis is not economic, right? It was, something outside economics. So it had nothing to do with economic fundamentals. The macroeconomic fundamentals were very good, very strong, even until like, early January this year, January, February. So it was totally unrelated to the macroeconomic events. So a sudden drop in interest rate was totally, unexpected. So it couldn't, usually, all the expected, anticipated events are priced in, meaning, it's already reflected in the price. But, something ad hoc, right? Something, ad hoc like this cannot be priced in, smoothly in the price. But anyway, this is the risk that comes with the interest rate, because the market interest rate is by sudden impact in interest rate, right? It can affect the valuation of our assets, such as bonds. Okay, so first of all, if interest rate goes down, because there's an inverse relationship, valuation goes up. In other words, price goes up. Well, that also means that if interest rate goes up suddenly interest rate goes up, then also it is, it affects the prices adversely, right? Valuation of assets adversely. Sudden, unexpected increase in interest rate. Now, so that's called interest rate risk, right? And if you remember, going back to our first topic, return on investment, we also discussed a lot about the risks at that point, because bond is, basically lending. Ultimately it's lending from the investor's perspective, and it's borrowing from the issuing company's perspective. So remember when we were talking about the cost of capital, right, in the ROI, we talked about the risk premium, because interest rate must reflect the risks, right? In other words, if the interest rate is just bare interest rate, right? The investors won't be protected against the risks, and obviously, it's not going to be attractive to the investors. And at the time we talked about this, and if you don't remember, just go back to the lecture notes at the time, and that is called studying. Some people just don't study at all. They just think, they just sit in a class, listen to the lecture, and they would understand everything. Grasp the total dimension of that. And you are just first you should know what you're incapable of. Then if you're not a genius, you have to, studying is going over and brain is not, I've noticed a lot of students, they know why they are there, not just intelligence, to attain the level of, limits. They know law equations, sense of, exigency. They freewheeling and free floating, them accountable to any. A lot of you were just pampered all the time, grade 12. It doesn't work hard, function. It is, of your time, yourself. You just don't look back on it. It means either one of the two things. Until you are supposed to do something about it. Not you must go back to the end until the end of the semester. If you don't understand and crack that to you in intelligence, you fall. You gotta know, what does that tell? Too soon over it. Oracle to you. Did you ever read sense to you? Public schools regimented are they have, because everything is day ones and made. I mean, you can say, Professor, can I still? And you can make up on your own a chunky value. You just say all those, and lay back and lax their own merits. It's not the reason. 48. I mean, if we are in class, there's inflation, and I told you, inflation risk is coming from the macroeconomic most obvious risk. First of all, the most obvious risk is the default risk. isn't it right? When you are lending money, the default risk is the most obvious risk. Second, there's inflation risk. Remember that, inflation. And I told you, inflation risk is coming from the macroeconomic system, right? So it's not default risk is specific to the individual borrower, right? Specific to the company, but inflation is across the board. It's through across the entire economy. So it's coming from the macroeconomic source, right? It's the risk coming from the macroeconomic source. And then third, maturity risk. Third one, in the order we did it in the first topic was the liquidity risk, but more than liquidity risk, maturity risk was very important. The fourth one was maturity risk, and I told you at the time, I explained it as it's the risk associated with the maturity, because the longer the maturity, right, the more uncertain it's going to be, because the longer into the future, the uncertainty increases. Nobody can tell, nobody can predict, precisely for the long run horizon, right? Most forecasts are relatively, I've been telling you, relatively more accurate for the short run horizon, like on the 1 year. But as the time horizon in this, right, the forecast becomes less and less accurate, right? So there's more and more uncertainty as the timeline increases, and that's why that's the risk associated with the maturity. And at the time, that was the only way I could explain it. Because at the time you guys didn't know what the time value of money is. But then maturity risk is also called now we can associate it with the time value. But maturity risk is also called interest rate risk. Why? Think about it. The time horizon, there are more chances of unexpected change in unexpected change in interest rate, right? Beyond actually 1 year, it's really hard to tell where the interest rate is going to be headed, or other variables as well, what the inflation is going to be, So think about it. The longer the horizon, in other words, maturity, right? There are chances that interest rate may suddenly go up, right? And this is why it is. And if interest rate goes up, what's going to happen to the price of the bond? Your bond holdings, any stocks or bonds, anything. When interest rate goes up, the valuation goes down, right? Now you understand this because we've done time value of money, because the discount rate, right? The discount rate goes down. If the interest rate goes up, discount rate goes up, and as the discount rate goes up, the valuation goes down, right? And vice versa. If the interest rate goes down, the valuation goes up. Now, so currently, the Fed funds rate is almost close to zero again. So then valuation is relatively, benefiting from that. But just because valuation is better.
Again, please take it with some grain of salt, because Fed funds rate is currently between 5.25 and 5.5, right? That was as of 2020. That was as of sometime around summer of 2020.
Benefiting from low interest rate, right? Doesn't mean that that could be one reason more people would put their money into the stocks and bonds, which would also explain why the stock market is totally disconnected with the economy, right? Because people, nobody will keep their money in the bank. I mean, in times like this, you would hunker down, and some people would hold on to the cash holdings, but this is very precarious situation. So they would put their money into gold, commodities like gold, because gold will usually, when there's inflation, gold is the instrument. Now, but anyway, think about it, if you're holding everything in cash, the downside is there's no return. So the market participants will try to put their money into something that gives the return, and on a steady base. So the bond is then preferred. But once again, bond yield these days, because unless the bond yield will go down if more investors put their money into the bond, and this is a time where people put their money into like treasury, because treasury is the safest. But then as the price goes up, you put your money into treasury, price goes up, the return goes down, right? So that's why the maturity risk is also called interest rate risk. So here's the empirical example of the let's take a look at the impact of coupon rate on price, and the impact of maturity on price. First of all, if the coupon rate is 0%, 5%, 7, 10, right? And on 30-year bond, 30-year is very long term, so fairly long term. And what's going to happen to the valuation when the market interest rate, not the coupon rate, right? Market interest rate, which is being used as the discount rate, the market rate goes up from 6 to 7%. If it is zero coupon, right, at the discount rate of 6% or the prevailing market rate of 6%, 30-year zero coupon will sell. The market price should be this. It will be like 169. So it is sold at very deep discount, right? 6%. If it goes up to prevailing market rate goes up to 7%, it's just 1% increase. Then it goes down to 126. So the change is negative 25%. Now, as the coupon rate increases, the coupon rate is 10%, and at 6% prevailing market rate, we can already tell this is going to be a premium bond, isn't it right? You can tell already it's a premium bond. This, it's 1.5, 1,500. And then at 7% discount rate, it's still a premium bond because 10% is much better than 7%, right? But the drop in the price is negative 11%, right? So you see, interest rate change will have, especially if interest rate goes up, will have a negative impact on its price. So it's also called price risk. Okay, so it goes by 3 different names, at least. Maturity risk, interest rate risk, because the longer the maturity, there are more chances that the interest rate would fluctuate, right? And then 3 is called, price risk, because the price will fluctuate as well. Now, and the impact of time to maturity, right? Time to maturity, impact of maturity on price. So let's assume same coupon rate, but different time left to maturity. 20 years, 10 years, 5, 2 years, right? And then if the discount rate is 6% and it goes up to 7%, right? If it goes up to 7%, and of course you can tell this is going to be a discount bond to begin with. Why? Because the coupon rate is lower than the, coupon rate is lower than the discount rate, so it's bound to be a discount bond. So at 6% prevailing market rate, 20-year bond will be the price at 884, but at 7%, 786. So the change or the drop is 11%, negative 11%, right? Change is negative 11%, drop is 11%. 10 years, we see 925, but at 7%, 850. So 7% drop. 5 years, 4% drop. 2 years, 1.8% drop. So also depending on the maturity, right? What the impact of the change in prevailing market rate is also significant. The longer the maturity is, hence called the maturity risk, right? So having this in mind, right? Maturity risk is revisited. So also known as price risk and interest rate risk. Long-term bond prices fluctuate more in response to change in rates than shorter-term bonds. Yes, you saw that. Talking about this, right? Long-term has more impact, and especially long-term bonds with low coupon rate. Of course, if you have a higher coupon rate, the impact is mitigated. But low coupon rate, you get blown. You get a big blow, right? You get really you suffer a lot, right? You get beaten up really badly. Short-term bonds with coupon rate, you suffer the least, right? High interest rate risk bond experience. Of course, if bond has high interest rate risk, there will be considerable capital loss when rates go up, right? Now, so here's another example of a change in price at different terms due to increase in interest rate from 8 to 10%. So as you read the table, right, you can see how the severe the impact is. So maturity risk graphically represented, right? It's simply because, look, what this is showing you is how, a 25-year bond, of course, if you hold it to maturity, you get 1,000. But if today is, year 15, right? Of course, because of the discount, right? And then another risk that it wasn't discussed at the beginning, of the semester, ROI, when we were talking about ROI, we didn't have a chance to talk about the reinvestment rate risk, because the four risks at the time was, simply default risk, inflation risk, and liquidity risk, and maturity risk, or interest rate risk. But then there is also reinvestment rate risk, because think about it. We've been assuming all along. We are assuming that if you receive interest from the bond or dividend from the stock, just let's assume you're receiving interest on the bond. We've been assuming that you can reinvest it at the same cost of capital. In other words, you can reinvest it in the same bond, and if you reinvest it in the same bond, then it will still earn the same coupon rate, right? But then this will not be the case, right? When interest rate fluctuates. Now, first of all, here's another thing. Here's one example. I mean, this is not the only example of reinvestment rate risk. Suppose interest rate went down, right? You are holding a bond. But let's assume a callable bond. I mean, it applies to both non-callable as well as callable bonds. But if we assume callable bond, it will be more. The example will be more striking. Suppose you have callable bonds you're holding, and it has still it's a 20-year bond, and now it is at time today is time 10, year 10, right? We are at end of year 10 at this point. So we still have 10 years left, but the bond is called. The bond has been just called, so you have to surrender the bond. Although you will get $1,000 face value plus one more year coupon interest as the call premium, right? So you have, suppose you have $1,100. Interest rate went down. Although you have $1,100, the fact that your call premium was 100 means this bond was paying 10% coupon, right? But now think about it. Overall, they call the bonds because the overall interest rate in the market has gone down. So the company can now sell new bonds at, let's say, 5% coupon, right? Or even lower. I mean, overall interest rate in the market is, let's say, average market rate is, let's say, 3%. Now then, what does that mean on average? What is your reinvestment return? Return on your reinvestment. I mean, in other words, on average, you will get 3%. Makes sense, because average return is now 3%. Average, on average, you will earn 3%. Well, you got your money back, 1,100, but this can no longer be reinvested at 10% anymore, because that rate. This is one thing, one example of reinvestment rate risk. But on other examples, so future interest chances that the future interest payments will have to be reinvested at a lower rate. Price goes down. Price drop is greater for bonds with lower coupon rate. Yeah, when rate goes up, right? Interest rate goes up, price falls, and this is greater. The price drop is greater for bonds with lower coupon rate, and because of the reinvestment rate risk. Because so let's look into this. If the interest rate goes up, bondholders' cash flows are discounted at higher rate, right? So it lowers the bond value, right? And since cash flows from low coupon bonds are smaller, right? Bondholders will have less money available from interest payments to buy new higher coupon bonds. Now with smaller, right? You got your money back. I mean, you sold. If it is a callable bond, you got your money back. If it is not the callable bond, you still have your money in the locked up in the bond, right? But then with the smaller coupon is small, right? Coupon payment is small, and with higher discount rate, your bond valuation goes down, including the smaller coupon value, right? So you have less money. If you sell these bonds now, you have less money available, right? To put into anything. So this is a dilemma, right? So holders of lower coupon bonds have their capital tied up in assets that are not making them as much money, right? So then this dilemma is what? You cannot sell, because if you sell, you will just realize smaller cash payment, right? With greater capital loss. And then with the smaller proceeds, you have to buy new bonds. And this is also the same thing, bond or stock. You face the same dilemma. When the bond, your stock, and your stock drops, usually you gotta cut loss, sell and cut loss. But if you miss that timing, if you sell, you just simply realize significant loss. Sometimes you cannot even recover 50% or even 20%. And when with that proceeds, you cannot recover. You cannot buy back any. You can buy back, but your equity holding, your stock holding or bond holding will be much smaller, especially in times of a high coupon rate, a high interest rate. In times of high interest rates, the valuation is relatively suffering. So with the smaller funds, you have very little choice of stocks or bonds to buy. I mean, you can still buy, but with very high interest rate, right? The stock market will be depressed, even if you invest. Also, bond market will be. You have to buy high coupon bonds, but even if you buy them, the price doesn't go up that easily because valuation is already depressed. Now, so this is the dilemma, right? Are you going to sell? And if you sell, you realize a big loss, right? And if you are afraid to sell, you hold on to it. The longer you hold on to it, the lower the valuation, right? As long as the strong interest rate is depressing the price. So this is right, facing the dilemma. So either way, you lose money, right? Relative to bondholders with higher coupon rate, right? If you're losing money relative to bondholders with high coupon rate. So you might say, oh, then why didn't you in the first place? Why didn't you invest in high coupon bonds? Now look, don't you understand what kind of bond is paying higher coupon of bonds? Remember, the higher the risk, the higher the coupon rate. Makes sense? In other words, high quality bonds, right? In other words, high credit rating. Why high credit rating? Due to low default risk. Those bonds with high credit rating, so AAA, AA, single A, these bonds don't pay high coupon. Makes sense? But the bonds that pay high coupons are the very risky bonds. I can tell you, fallen angels, double B, single B, fallen angels, triple C, and that brings us back to right. I showed you this table before. So bonds in this lower ratings, they pay high coupon, but they are very risky. See, low single B, low quality risky, and triple C, low quality possible default. Right? Double C, it may low quality, may default, but recovery is possible. Single C, defaulted, it has already defaulted, and recovery is unlikely. Right? That and they are generally called junk bonds, right? They're generally called junk bonds, right? These are called fallen angels, but overall low triple B generally called junk bonds. And I've been telling you, junk bonds sounds very derogatory, right? But that doesn't necessarily mean they are bad. They just are very risky. On the other hand, they pay very high return, so they are just simply as risky as the stock, right? Something like a triple C, double C, typical example of junk bond, right? And that brings us to, I also talked about this before, bond rating agencies. There are globally renowned, three rating agencies that are globally renowned: Moody's, S&P, Fitch, IBC. And I've been telling you, Moody's and S&P are U.S. based rating agencies. Fitch, IBC is British, I believe. Let me. Oh, you may not see this, but if you click on that, that will take you to their website. Okay, so now then that brings us to the yield curve differentials, and we already know what yield curve is. We discussed it, in the first topic, all right? But the low quality, the yield between high quality bond and low quality bonds are relatively steady, right? Differential between high and low quality bonds, right? Yields are relatively steady. So that and I talked about the difference, the yield differential between 10-year Treasury and like 3 months Treasury bill, right? 10-year Treasury note, the difference between 10-year Treasury note and 3-month Treasury bill, the yield differential is usually used as the indicator of the recession forecast, right? Why? Because 3-year, so another story, because this is that's long term and short term, and this one is high quality bond and low quality bond, and this difference can be used generally as the risk premium, right? Risk premium between the risk premium to make adjustment to the cost of equity, right? In other words, to find the required return in a very crude way, required return or the discount rate for stocks in a very crude way, they use this differential as the risk premium for. But that's because it's a crude way. We're not gonna actually use it. We're gonna because for stocks we're gonna be using more sophisticated risk adjustment techniques. So that wraps up everything about the bonds. So this is we have a few more slides, but that's not for this class. It's not really necessary to go into this. This wraps up everything about the bonds. So now I want you to we're going to start on a new we're going to set foot on a new topic today, which is risk and return. So as a preparation for that topic, we're going to actually do something to calculate risk and return. So we need the data. So let me go back to okay, let's go back to this screen, right? This is what you can see, but it's not really sharing. I don't know if this is what you can see, but let's see. Oh, this is not right.
So we're gonna do this
How do I select only one?
Actual data exercise from Yahoo Finance.
Okay, so to Yahoo Finance, and let's see if I can. So is this what you see now? Yahoo. So if you're on Yahoo, go to Yahoo Finance and let's look up Apple. Okay, Apple's ticker symbol is AAPL. I mean, you don't need to know the ticker symbol these days, but even in late 1990s, you had to enter only the ticker symbol in the search window. Apple's ticker symbol is AAPL. These days, if you just type in Apple, it's going to come up, right? So we want to look up Apple's data. Okay, so here. So I got Apple, right? So Apple, as of yesterday, Friday, April 17th, at the closing of the market, right, 4 p.m., Apple was 282, and it looks like Apple, had a bad day. But look, this is just intraday, what they call intraday transaction record. We need to look at the, for example, it was only from 10 a.m. through like 9:30 a.m. through. So if you select 5 years, right? If you select the time horizon, right, over the last 5 years, it's been doing okay, right? And obviously this means this was like March something, right? March 19th or around the time. All this is totally unnecessary. I mean, we can do we can actually look at the chart and we can look at daily movement, right? Price actions, right? But this is not what we're interested in. What we are interested in is the actual data. So we go to the data, historical data. Okay, you click on that, and then what do you do? We want to look at the past 5 years. So select, right? April. I think I better do. We will need one more. We will need one more data point. So we're gonna go to 2000. Oh, no. 5 years back, like 2015. We can start from March. That's fine. And click done. And we need monthly price. Daily, we don't. It's too much fluctuation. So we'll select monthly and hit apply. And you will see it's monthly price that you see. Today is April 17th. I mean, the day. This is not the day you are watching this video. This is the day I'm recording this video. And you have some people were, this is just a common sense. If you are sensible, it's obvious, right? This doesn't need to be explained. But some people, there was a student who was asking me on the, who was trying to argue with me. I cannot see, blah blah in the discussion board. Where's your thread? My thread was there, in the discussion forum, and the thread was, today it says today's lecture, and it was dated, not as of that date, but some prior dates. But then the student was saying that was not today's lecture. But where are you in now? You're in today's forum, right? No matter what the timestamp on that lecture, my thread, no matter what the date of the timestamp is, as long as you're in today's forum, then that's today's lecture.
Okay, let me buy that.
If you're being, timestamp on that and post it. So here, we got, April 1st, but this is not really the April. Okay, this is April 1st, but March 1st. This is not March 1st. This is actually end of March. Okay, why? It's just the way for April. April isn't over yet, so April 17th transaction is there. But when April is over, actually the last day, transaction of the last day, will be timestamped as April 1st. This is just the way the date is recorded, right? This is just the way the timestamp is put on the data. Look, this is the monthly data. And think about it. What would be the, what do you think is the price that represents the price of that month? The price of the day's trading, price of the day's trading. I mean, there are 4 price points, right? Beginning, closing, high, low. Which one is the price that marks that day? That's the closing of the market, isn't it right? No matter where the market opened, no matter how high it reached during the day's trading, no matter how low it went down during the day's trading, doesn't matter. The conclusion of the day is always the closing price of the day. Make sense? Closing price. So we are dealing with the monthly data. So on although the timestamp is February 1st, this price represents the closing price, close of the end of the month, right? Of course, we have close, open, high. So this means high opening of the month, the highest of the month, right? Lowest of the month, closing, and then there is adjusted closing price. You also see dividends paid, right? And I've been telling you, dividends are paid in the following quarter, right? You cannot pay the dividend of the 4th quarter as the 4th quarter ends. Make sense? And this is something I already explained in class. I don't want to go over it again because we are, we don't have, a luxury of time. But at least I want you to do one thing. We need to download this data. But before we download this data, because the way it is now, it is just on the web page, and there's nothing you can do. You cannot do something to the data that's on the web page, so we will have to download it to a spreadsheet, right? We'll do that shortly. But what did I say? December has to end, right? 4th quarter 2019 has to end, and after the end of the 4th quarter, they will compile the data, right? And then they will report earnings around the second week of the first month. I mean, as early as the second week of the first month of the following quarter. So in January, they reported earnings, right? Earnings per share, earning EAT, earnings data. And in the second month of the following quarter, they pay out dividends from the previous quarter. So here, November dividend is actually dividend from the third quarter. Makes sense? And the dividend, theoretically, dividend is tied to the EAT, right? Earnings per share. So it would change with the earnings per share, but in reality, they just pay out fixed amount. Anyway, so how do I download this? Well, you see here, download data. So click that. It's gonna, right? So just gonna download it. So you open it. This is how it looks, but I'm going to first of all, the way the volume, the number is expressed, you're not familiar with this. And this font, this is the default font, a Calibri size 11. I don't like that. I mean, personally, you may like it, but this is not user friendly or vision friendly. For me, it's not vision friendly. And this, the numerical data is presented this way, this is this easily makes people lose interest in the numerical data. So the first thing I do is I'm gonna treat the data, right? I'm gonna need the dough, right? I'm gonna treat the data in the best way. So I highlight the entire spreadsheet. You just saw what I did. Click on this, right? Click on this corner. Entire spreadsheet is highlighted, and I can change the font face to something I like. I like Bakersfield. I want to increase the font size to it's decreasing, something like 12. This is decent. And when you double click, when the entire spreadsheet is highlighted, I double click on them. Double click. It's gonna expand everything. Now, although this is the we have a lot of so I'm going to we have multiple columns, but we need only one column, 2 columns only actually. So first I'm going to label. I'm going to put a label. I'm going to bold, put a bold and underline and center line.
Okay, so the Excel is not somehow I forgot to when I made this video, somehow I forgot to show Excel on the screen. So anyway, you don't have to worry about that. We're gonna do this actually, later on. So just bear with me until this, this runs out. Okay.
The labels. I'm gonna first. I'm going to sort it in descending order. Okay, sort it descending. So the most recent will come on top, and then I'm gonna copy the entire data set and open another sheet and paste it there, because I'm going to leave the original data set as it is, and I'm going to then only first of all, I'm gonna, as I said, I'm gonna need only 2 columns. First, date column and the price that represents the month is always any trading, right, period is the closing, right? So I don't need the others, so I'm gonna select those columns and delete those columns. And then volume is not necessary, it's not needed for now. I'm going to delete that. And between what is this, close, adjusted close, they seem awfully they seem like what's the difference? But here's the difference. Look, when they made dividend, a dividend isn't shown here, but when they made dividend payments in February, close and adjusted close prices are different. November, right? They made it's different. So what is this? Adjusted close price is, you will see. Oh, I'm sorry, you were probably all this time. You don't see this, right? So I'm gonna go back to. Oh, okay. Well, the whole thing. I'm gonna have to go back and. Okay, so let me go back to. All right, this is what I'm talking about. So I downloaded the data, right, and then by selecting by clicking on this, I select the entire spreadsheet, and then I change the font, right? Okay, which means while the entire spreadsheet was selected, I clicked on I changed the font to what I like, and then center line these labels and underscored these labels, and so on, underline these labels. Then I sorted also. This is in ascending order, but I sorted it into a descending order because I want the most recent price to come on top. So I sorted, right? And then after that, I highlighted the entire data set and also pasted it on the second sheet, right? Second spreadsheet. And from there, because I don't need these 3 columns at this point, delete it. I don't need volume at this point, I delete it. And then I was just about to explain what is close and adjusted. I adjusted close price. I mean, if you go back to Excel file, you will see what it. If you go back to the Yahoo Finance, there's an explanation about adjusted close. Adjusted close is the basically a price adjusted for stock splits and dividends. Okay, so I'm gonna go. We're almost out of time, so I'm gonna have to explain the difference in the next class. But as long as you have come to this point, right? That's fine. That's good. As long as you have come to this point, you are okay. And I'm gonna label to PT. No. I'm gonna do that next time. So actually, the data we're gonna use is adjusted close. Okay, so that will be our discussion in our next class. Okay, so that's it for today. End of video.
All right. So now we got 2 things to do. First, go to. I updated this file, right? So if you have already downloaded it, fine. I mean, if you have already, I mean, we've been working on this file since a couple of days ago. So you must have this file already downloaded and saved on your computer. So you can open it. You can open it. Or if you don't have it, you can just download it again. Okay? So I'm going to just open, I'm going to open, yeah, this one. I'm going to open it because that was already downloaded. All right. So we did yesterday. We did this exercise, right? Tips, right? Tips exercise, right? And we have some more. I've updated it. Well, I updated it yesterday and posted it, reposted. And there's a few more, right? But what we want to do today is this one, right? Okay, so everybody has this. Everybody has this file opened in front of you. Everyone. Okay. Are you guys there? Anyone listening?
Yeah, I'm here.
All right, good, good. All right. So let's do this example. Remember, this is the price. We want to use the price function, right? To use the price function, I told you to use Excel's price function, we need to express all the prices in percentage of the face value. So this is 100% of $1,000, right? Ignore that dollar sign. It's not $100. Face value of the bond cannot be $100. Back in 1960s, the face value was $100. But since then, it's not $100, right? $1,000. So this is percentage price. Of course, you will see percentage price here as well. Percentage, right? Price as percentage, right, of the face value. and you should give it calendar dates for today's date and the maturity date. So I'm going to change, first of all, remember this is this example. This is exactly, where is it? This example, right? 15-year bond with coupon rate of 5.5%, right? Of course, coupons are paid semi-annually. Discount rate or prevailing market rate 6.5. Currently, it's priced at 940, but that's market price. But is that the correct price? I mean, is that the fair value? Fair value, right? Or rational price or intrinsic value, right? So we wanna find out, right? We wanna find out. Uh, so everything is already set up, right? But once again, this is $1,000, right? Just expressed in percentage. Coupon rate is 5.5. So coupon payment is not $2.75. It's not $2.75. Once again, it's percentage, 2.75%. 2.75% of $1,000. So every 6 months, coupon is $27.50. And that only makes sense. It stands to reason. What? Think about it. If the coupon rate is 5.5% of $1,000, annually it will have to be $55. Then semi-annually, $27.50. Time to maturity, right? Time remaining to maturity, 15 years. Prevailing market rate is this. Then half year rate, right? Would be like this. I don't know if I explained what internal rate of return is in the video, but if not, uh, never mind. I'm gonna get to that later. And to make it more relevant to us, let's enter today's date because today is, come on. Oh, this is not the wrong keyboard. Wrong keyboard. Let me get the right key. I was hitting on the wrong key. Oops. Why is it not showing? Okay. My something was. Oh, my HDMI is not. Okay. HDMI cable was something's wrong with my HDMI cable. Anyway, so today enter today's date, which is 011 0811, and you don't have to enter 2023 because by default Excel will recognize today's date as Excel will pick today's date, which is 2013 23. Oh, I had to do that. Oh, because right, because I even put another slash here, and then maturity will be automatically calculated, right? It's 15 years, so 365 days times 15 years, right? And that's the only way computer recognizes calendar date. It goes by days. You cannot just add E19. If you just add E19, it will just add 15 days to this date, right? So there you go. So actually, it will be with some adjustment. It will have to be also August. It will have to be August 10th, 2030. Now let's go to Excel's built-in function. So you can click on this, insert function, right? And go to financial category, financial functions. Scroll down until you find price. There is price. Okay. And it's asking for all these inputs. Settlement. Settlement means settlement date, right? You enter this, right? You click it in. Maturity. This is maturity. Click it in. Rate means coupon rate. So click it in. Yield. Yield means discount rate. This is yield, right? And then redemption. Redemption value. Redemption is the face value. Redemption value, face value, right? Par value, same thing, right? And scroll down a little more. Frequency. This is very important. Without this, it's not going to work. Frequency. And we got something already here. Hit OK. We got this. But again, once again, it's not $90. It's $905.10. $905.10. So you can now determine, you can tell, oh, if it is currently going for $940, that's overvalued. You don't buy that because if it is overvalued, your yield, your return will be lower. No, nobody should buy, something like this. Anyway, next. This example came from somewhere, but I don't know. I don't remember. But let's say, what should be the 3.5%? 3.5%. I think this, right? It's this example. Where did I get the? Where did this example come from? So I should have the. Now, if the PM stands for, market price. Actually, so that's the price it's going for in the market. So for intrinsic value, I should have used B. But previously in this example, I used PB for intrinsic value and PM for market price. We gotta know what market price should be, which and let's say. Let me see what was in the original example. Okay, let's see. Oh, not that one. So to find the yield, oh, 961, how did that come about? So when yield is your unknown, right? Yield to maturity. When yield to maturity is your unknown, that means market price is given. Of course, market price, just like this. Market price is something, it's an information that you can get from the market, right? Whether this is correct or not, it doesn't matter. Because obviously we can tell, we can calculate once, discount rate is given, we can tell whether this is overvalued or undervalued. If it is overvalued or undervalued, it's all mispriced, right? mispricing, right? But anyway, given the market price, whether it is mispriced or not, if the market price is given, we want to know what the yield would be, what the yield should be. So what you can do is, if this is the market price, of course, this is, percentage, right? It's the price expressed in percentage. And this is negative. And I told you, it's not really negative number. It just means cash outflow, right? And to use, Excel's built-in function, I had to make the distinction between, cash outflow and cash inflow. And this is cash inflow for sure. Of course, if you buy the bond at maturity, you get 1,000. That's cash inflow. And to buy such a bond, you have to pay this. So that's cash outflow. So which should be a negative cash outflow. That's quite obvious. But to use this, you cannot use negative number. So I put minus sign here. So minus times minus is positive, plus, right? Minus is plus. So to turn it back to plus, positive, I put minus sign there, and I divided it by 10, right? So that it would be expressed as of percentage, right, of $1,000. So here, I'm going to use, so this is a bond that has 3.5% coupon rate, right? Of course, coupon payment will be $17.50, but just expressed in, right? Yes, percentage. So go to function, and if you're in the financial category already, we scroll down until we find yield. So here's yield. Hit OK. And once again, give it what it's asking for. Settlement date, today's date. Maturity. You might wonder, why is it different? Now, time to maturity is only 4 years, right, in this example. Rate, I've been telling you, is the coupon rate. Price, that's price, right? The price. Redemption value, of course, this is the redemption value, right? And one more thing, frequency, 2. There you go. And we got something here already. Hit OK, 4.53. And you can check if this is correct. To do that, we'll use, we'll use, rate function to verify that. So first, this is the same example as that. Isn't that right? Because the only difference is here, in this example, it's scaled down by 10, by the factor of 10, because everything has to be expressed, prices must be expressed in percentage of $1,000, right? Therefore, but however, here you can have it as, its original. So here, we need to find the periodic rate using Excel's also a rate function. So click on, right, rate, go there and find the rate. Hit OK. Give it what it's asking for. N period, N, payment. This is the payment. present value, right? Future value. Now, present value has to be in negative, right? Because that's cash outflow. Type, once again, I told you, type means, whether it's annuity due or ordinary annuity, but bonds are all ordinary annuity. Think about it. There's no, uh, there's no bond that pays your interest at time zero. You will have to wait, right, to collect interest. So you enter nothing here. We got something already here. Okay, what is this? This is periodic rate. In other words, half year rate. If it is half year rate, to turn it into a full year rate, all you need to do is simply, why is my keyboard not working? Okay, this times, where's times? This times M. You see, we got the same result, right? So this checks out, okay? All right, I wanted to do also we're gonna have to download the data after the break. It's 7:18, so we'll take a 10-minute break and reconvene at 7:28 or 29. And we're gonna go to Apple's data, okay? All righty, so let's take, all right, let's take a 10-minute, okay? Let's take a 10-minute break. 10-minute break. All right, we're back. We're back. Okay. Uh, hold on, Brandon. Okay. Okay. All right, no problem, no problem. I'll take care of that. All right. So now we're gonna actually um, download data from Yahoo Finance. So I want you to go to Yahoo Finance, right? Everyone, okay. I'm let's, let's simplify it a little bit. Okay, I'm not gonna. I'll just click on. Yeah, today the market was kind of going sideways. You know, I've been in the morning. I mean, during the morning trading, my portfolio actually went up by about uh, what you know. I can't simply calculate the percentage, but yeah, probably about 20, 12, 12, 13, or 15%. You know, at least regained my loss from yesterday. But then in the afternoon, it just paired all the earnings. You know, paired all the gains. You know, it gave just ended up pretty much where it stood yesterday. But but that's not what I'm here to talk about. I want so if you're in Yahoo Finance, let's everyone is at Yahoo Finance, right? Everyone. I'll have to assume that you are. Everyone is at Yahoo Finance.
Yeah.
Okay, only one person. So we want to look up Apple's data, right? Apple is AAPL. Ticker symbol is AAPL. However, you don't need to. You can just type in Apple and it's going to come up, right? So Apple is today it lost. You know, doesn't really matter. We want to get to the historical price. So historical data. We click on this, and then um, we want to get monthly data, monthly, right, for the last 5 years. So you'll set the data frequency to monthly, and we'll start from August. So just to have enough data points, uh, we're going to start from uh, July of 2018. Okay, so end date is this. Uh, Start date. You can just type in. I mean, I'm gonna because you can do this too, but you're gonna have to click so much. You're gonna have to click so many times to get to. Yeah, no, almost there. July 2018, and select first day, right? Because which date, July 1st or July 2nd, 18th, 10th doesn't matter because anyway, it's monthly data we're gonna get, right? So then done. So June 30th is basically the same thing. Apply, apply. Now we have monthly data, right? And then every 3 months you see dividend, right? Every 3 months. And it's not random 3 months. It's always the middle of middle of the quarter, middle of the quarter, right? And middle of the quarter because and this dividend is the result of the performance of the previous quarter, right? You cannot pay out dividend of the current quarter during the current quarter because the current quarter hasn't ended, right? Obviously, um, so we're gonna download this right here. Uh, so when you have so everyone has it in monthly data form, isn't that right? Everyone has it in monthly data, right? Everyone.
Yeah.
Okay, good. Okay, only yeah, only two people. What about the rest of the?
I'm
I
here.
don't have.
I'm listening. I'm listening.
Okay, all right. I need some confirmation so that
I'm
we can
listening,
move.
Professor, but my daughter is talking in the background. That's why I try to keep my.
Okay, okay.
Sorry.
I'll give you some time. So all we need to do is now click on download, right? So are you guys ready? And yeah, I hope you guys are ready. So click download. And in
Ready.
your folder, okay? So in your folder, now it's downloaded. So open file, okay? Now it's raw, the raw data, it's in raw form, raw. And it's really raw also in font. So I don't like I don't like to work with this font because when you're working with data, numerical data, and lots of numerical data because I downloaded 5 years worth of numerical data, right? Data, price data, right? Then that means 60 data points, at least 60 data points, right? 12 times 5. And if you have a longer data set, like for 10 years, 30 years, working with something like this is really not um, nice. It's really not good for your eyes. You might, uh, and if you have a weak vision or weakening vision or whatever, it's gonna be it's gonna do a damage to your vision. So I always want change the font. I always change the font, increase the font size to something like 14, and change the font style to something more pleasant to your eyes. Okay, I normally use Bakersfield old, but you can choose Times New Roman, Georgia, or Times New Roman. Usually Georgia is nice font. Times New Roman is very standard. You can scroll down till you see Times New Roman. But now when you change the font, first of all you have to click on this corner, then the entire worksheet will be highlighted. And then that means whatever change you make will apply to the entire worksheet. So now everything you type in there will be in uh, your preferred font, right? Your chosen font. Now I'm gonna leave it like this, and because that's the original data, right? And open another worksheet and copy everything. Select, click this corner, and entire worksheet will be highlighted and it will be selected, right? Copy and select this cell, A1, paste. Okay, now it's pasted. Now date, it's in ascending order, but it will be more convenient when you put it into descending order, because for the things that we are going to do, we need it to be in descending order. In other words, the latest data on top, right? So just select the cell and go to home and sort newest to oldest, right? And everything is sorted together. Today is not, look, clearly, today is not August 1st, but this is, as I told you in the video, this is the way this is the way the data is formatted, right? The data is given, identified, right? They don't use, it's monthly data, so there's no actual date. This just represents the most recent August, right? And today it closed at 178. Remember that? Today it closed at 178. And this month it opened at 196. Now, so this is July. It opened at 193, closed at 196. So anyway, we have 61. We would have 61, 62 data points. However, we need only we just have two more extra data points. We need only 60, right? Because we're gonna calculate return, so we need only 60. For now, what we are gonna do is we don't need high-low. We don't need high-low. Open high-low. As I said in the video, the price that represents that day's trading is the close price, right? And so for the month, it's the same thing. The price that represents that month's trading is the closing price. So open high low, we don't need that. So highlight those columns and delete. And I don't need volume for now. I mean, volume here as well. How meaningful that price action is. That is, I mean, think about it. Price action can still happen even only one sell or buy of just 10 shares take place, right? In other words, if price went up or went down because as a result of a large volume being traded, like 10 million shares being traded during that day, then that's a strong there is a support. That's a supporting evidence for that price action. However, just 10 stocks were traded for that day, but still, it's a price action. It's gonna push up the price or pull down the price. That is not a strong supporting evidence of that trend, right? Makes sense? But we don't need that for now, so I'm gonna delete that too. And we have now then close price and adjusted close price. And what is the difference? Adjusted close means it's close price adjusted for stock splits and dividends. Of course, Apple had several splits over the course of several decades, and after split, the price will have to be prorated. In other words, Apple was like $660 even in June of 2000. When was that? let's say it was, let's say 2016, okay, or 2018. I don't. And in June, then they had a split, like a 7-1 split, something like. So one stock split into 7 shares. So if you had 10 shares, then now you have 70 shares. Now price must be prorated. In other words, if you divide 660 by 7, it will come to something like $90 or whatever, $89. Now then think about it. The price before the split, it should be adjusted as well. It should be prorated. Otherwise, think about it. If you plot these prices, the graph will show a sudden drastic fall, right? And that might cause confusion to people who didn't know that Apple split. And even to the people who knew Apple split, the stock split, this will be very, this will be sending out conflicting message. So after split, the pre-split price needs to be adjusted or prorated to be in line with post-split price. So that is one thing that is adjusting for. Second is dividend, because dividend is paid only quarterly, right? It's not every month. So you need to make this, you need to reflect this to monthly price. Anyway, if they don't pay out dividend, that dividend is still reflected in the dividend is still reflected in the stock price, right? Because it wasn't paid out. Now it is captured. It should be captured in the stock price. So I'm not gonna. I'm not gonna use adjusted close price. I will use close price. Okay. So you can delete it. Okay. So everyone is okay up to this point. Everyone is following.
Yes.
Okay. Good. Good. So now I'm going to change this to label. I'm going to change this label to PT, okay, which is price at time T. Okay. And now I want to find return. I mean, the reason we've done all this is to find return. But so I will put the label RT here. I'll change the label to RT, return at time T, right? And I will save this file, but when you save it, I will save it for now. When you save it, please don't just click on this, because you need to save it as Excel file. You might wonder, isn't it Excel already? No, it is currently CSV file. CSV file is not Excel. It's just a text file, something like text file. So it's not gonna retain the format that you have applied. So you select Excel workbook, and you can name it Excel. I will rename it as Excel Apple 23 Summer. Okay, Apple 23 Summer. You can name it whatever you want, but I'm doing this every semester. I need to give it some name that will tell when this data was taken. Okay, once you have saved it, now let's just close it for a while and we're gonna go back to now we are going to topic 5 because we need to topic 5, and let's take a listen. I mean, this continues from that data we downloaded.
Dr. Jeff Holm, and since our last class, we've been we just started on in the last class on the new topic called risk and return. Actually, we wrapped up everything about the bond in the last class, and towards the tail end of the last 5 years, and then we have
Okay, I'll skip this.
Downloaded, but when I usually, when you download the data, it's in like a font face called Calibri, and the font size would be 0.11. But I told you the importance of cleaning up the data. Also, while you're cleaning up the data, you would, if possible, change the font, because if you're really
Done this.
longer as a save that, right? So my next sheet and paste it here, and then I deleted all the other columns, leaving only close and adjusted close price. Last time I told you the important, although there are 4 price points, right? Open, high, low, and close, right? Open, high, low, they are all irrelevant, right? Because the conclusion of that for the month ended. So this date formally, but whether okay, I mean, what if the first day I'll show copy just right, just delete is left. So then next question is, what is it closed? So web page, Yahoo Finance web page, most February dividend quarter during the current quarter, the data imported, right? Then every month, other than the out of 3 months, 1 month.
Okay, I'm gonna
return is, what thing is. There must be capital gains, right? Or capital loss. And then cash flow, sum of all the cash flow during that holding period, right? And divided by price at time t minus n, right? So, or price at time 0, right? So what that means is, suppose we are at time t now. We're just, at the end of time t, then the price capital gains is between the price at time t and price at time t minus n, right? N can be, any number, right? Like it can be n can be 5 years, 2 years, right? And then that's capital gains, right? And sum of all the cash flows during the holding period. So holding period is actually between t minus n t, right? So there will be n cash flow n periods, right? Or n period. Okay, so this is holding period return, right? But what if it is, just a single period, one period? So if holding period is just one period, we'll just call it, let's call it RT, okay? Return at time t, right? And what is return at time t? Of course, it would be capital gains, but capital gains for one period. So one period means, there will be a price at time t and price at time t minus 1, right? There will be a price at time t, and that's one period, right? So, and then there will be, and if you're talking about stocks, right, there will be, during this period, there will be a dividend. Cash flow is dividend, and one period dividend, right? Dividend at time t. And then during, the price at the initial price is, right? Price at time t minus 1. Okay. Now then, let's think about it. What is the then one period? If the holding period is one period, right? One holding period, and during this holding period, if you're getting one dividend payment, right? What does that mean? This will be at least a quarterly holding period, must be at least quarter, and this is quarterly price, right? This is the price at the end of this quarter, price at the end of the previous quarter, right? Make sense? But then here we have a problem here. First of all, you understand that not all the companies pay dividend. Not all the companies pay dividend. There are some companies don't pay dividend. Some companies pay dividend. And even if the company pays dividend, it may not pay consistently every quarter, right? Sometimes they skip, right, the dividend, and they may, by the decision of the board, they may stop paying dividend for a very long time, and then then resume paying dividends after 10 years or something like that. Apple actually did that. Apple stopped paying dividends for almost like 10 years in the early 2000s, and then started to pay dividends again from around 2012, I believe, if I remember correctly. So if the company doesn't pay any dividend, this doesn't matter. I mean, this is irrelevant if it doesn't pay any dividend, right? Doesn't matter. But this becomes a problem. But the problem is, are we dealing with quarterly data? Are we dealing with quarterly data? No, we're not dealing with quarterly data. We are dealing with monthly data. And if you are dealing with monthly data, we have a problem. Why? Because 1 out of every 3 months we have dividend, but then the other 2 months without any dividend. So in other words, there will be like a little spike every 3 months, right? Of course, we can make adjustment every 3 months, but then this will be a tedious job if you're dealing with. Remember, we downloaded past 5 years worth of data, right? And that's the data points. Actually, we downloaded 61. And if you're dealing with like 60 data points, right, making this adjustment every month, every quarter, right, it's going to be a tedious job, right? So what we do, instead, we will use adjusted close price. Then that means every month, the price every month, it has already priced in, right? It's been adjusted.
Yeah, I used previously. I used adjusted close price. However, I think the difference is very slight. There is a very minute difference, so it doesn't really make difference. But if ever, to be fair to the companies that don't pay dividends, right? It's better to use close price, not adjusted close price. Besides, if you use adjusted close price, then because dividend is already paid out for that particular month, the capital gains is not capital gains, but the what would have been if the dividend wasn't paid out, what would have been part of the capital gains is simply paid out as dividend, so it will slightly understate the return. It will slightly understate the return for that month, although it would be a very minute difference. So I'm using close price, okay? But this, just so take it with some grain of salt, because previously I used, adjusted close price, but then it would be slightly slightly understate that particular month's growth, right?
For that dividend. So you don't have to worry about dividend when you are calculating the monthly return. I mean, if this return is monthly return, then this dividend becomes a problem, right? Because not every month you have this data. But price then for stock, the past classes, I've told you that liquid reason, right? Remember that? All occasions. Now, if the stock becomes too expensive, right, then what happens? From the day one, they split for liquid reason.
Why split? Why?
Right? Remember that? In one of the past classes, I've told you that stocks sometimes split, and why? Well, they split for liquid reason. Right? Remember that? From the day one, when we started talking about return on investment, I talked about this on several occasions. Now, if the stock becomes too expensive, right, then what happens? The stock becomes less marketable If it becomes too expensive, it becomes less marketable. And I gave you an example with the municipal bond. Remember, the municipal bond has face value of $5,000, whereas all the other bonds, corporate bonds, Treasury has $1,000 face value. And if so, suppose you have only $5,000. If you buy Treasury, or if you buy corporate bonds, you can buy about 5 bonds approximately, right? Of course, depending on whether it is a discount bond or premium bond, it could be less than 5 or it could be more than 5. But since you cannot buy a fraction of one, if the bonds are discount bonds, you may be able to buy 5 with $5,000 and still some money left, right? If it is premium bond, you cannot buy 5. You will buy less than 5, maybe 4, and some money left. But think about it. If you use that $5,000 to buy a municipal bond, you can buy only 1, right? And then think about it. If you need, suppose you put it into a municipal bond, then you can, and you need something happened, and you need cash very urgently, right? And now, if you have, suppose you need, $2,000 urgently. If you have 5 corporate bonds, you can sell two of them, and in other words, cash out 2, and you get $2,000 in cash, and still $3,000 still in the bond. So you can continue to earn. Let's say if the coupon rate is 10%, you can continue to earn 10% on $3,000, right? If it was corporate bond that you bought, but if you bought the municipal bond, then there's no way you can conveniently cash out only $2,000. Just to cash out $2,000, you will have to sell the entire bond, and then you now have liquidity, but then no more interest, right? No more coupon on the muni bond. So that is the reason. The same logic, same reasoning applies to the stock. And I told you before, Apple was about $660 in 2014 before it split. Around September of 2014, it's Apple split. Until then, it was like $660. And it was like a 7-to-1 split, 7-to-1. That means one stock split into 7. So each stock was, then 60 divided by 7, probably $90 or 80 something dollars. So the stock, the price per share became much cheaper, but that doesn't mean you lose money, because if I had 10 shares of Apple, my total investment, my total value of my investment was $6,600, right? And after split, then my number of shares will be 70, right? 70, and then each share is if it is $90, right? 90 something, right? Suppose just to make it simple, $90 times that's going to be 6,300, right? So actually, it was 90 something. So the total value is the same. But think about it this way: stock becomes more marketable, right? People who were shying away from buying Apple because of too high face value, right? The market price, too high market price, because of the liquidity concern, right? Now can buy Apple more readily, right? So then that's the reason they split, right? But then the next question is, once you split, what happens to the data? If you look at the price data, until like September, it was 660, and then after split, it suddenly is 90 something, 97 or something. And think about it: if you didn't know anything about the history, right? Whether they, if you had no idea whether Apple split, looking at the data, what would you think? You might think Apple crashed suddenly one day in September, right? And besides, so first of all, the data loses continuity because there is a sudden break, right, or disruption in the continuity of data. And how would you, between September and October, how would you calculate the return? You would subtract the September price, right? September price. You would subtract the September price, which is like 660, right? You would subtract that from the October price, which would be like 98, divided by 660, right? Don't you think this is crazy? I mean, this would give you definitely a negative return, significantly negative return, right? So obviously, this is a very stupid thing if you do it like this. So what do? You will need to adjust all the pre-split price, pre-split. This is the pre-split price. You will adjust it to post-split price, right? Makes sense. So that the data will run smoothly. So let's say if in October if it was $99 and pre-split price was like $660, but then you adjust it to something like after split, adjusted for that split factor, this becomes like let's say $95. Then the data will run smoothly. You understand? Okay. So let me go back to the Excel and then just at close price. So then I'm not gonna. I will not delete it. I'll just close that column and change the label right to PT because that's a dollar price. That's the price, right? And then I won't need. So this is April 1st, and if we already at the end of April, right? It will be marked. It will be noted as 5/1. Right? You understand? 5/1. May 1st represents actually the then it would represent the okay. So let me delete this, okay? Because currently because this is we're not at the end of April, but by doing this we this is the latest March April price now. So now it is consider this as the end of the month. So I want to calculate return. So how do you calculate return? Remember, one period return or the monthly return is PT minus PT minus 1 over PT minus 1. Okay, then this is PT, right? Then what is PT minus 1? Where is PT minus 1? PT minus 1 from April, PT minus 1 price at T minus 1, previous month. It is March price, isn't it right? It has to be March price. Makes sense? It's the March price. So then that's PT minus 1, isn't it right? Then PT minus 1 over PT minus 1. Okay? So then this is monthly return, right? Hit enter. Okay, I will give it the percentage, right? Percentage, and give it at least 2 decimal places. Okay, now I would like to give this also $ because we have so many digits, but if it is in dollars, we don't have any more than 2 decimal places. I mean, meaning we don't use anything more than anything less than a cent, right? So and I can, because it's the same formula repeating over and over, I will just copy and drag it all the way down. Okay, but I will stop here because it won't compute any return because to compute return there has to be data, right? But that's fine. That's fine. Why? We have as long as we have 60 data points, right? That's why as long as we have 60 data points, right? 60 monthly data points. There are 60 of them, right? Because 5 years is 60 months, right? So we got the monthly returns. Then naturally, your next question, you will wonder, okay, I got the, wouldn't you want to know what was the average monthly return in the last 5 years? Yes, you would want to know the average monthly return. So what do you do? We'll take the average, right? So to take the average, you can simply type in, as you type in, ABER, you get average come up, right? Double click and simply highlight this data range, right? And there's going to be 60 of them, right? And then voila, that is the monthly average, right? Average monthly return. So this is called expected return. Or average or mean return or expected return. Now, of course, you understand that the average is mean, but why is it also expected? Now, expected value, expected return, when we say expected, this says, expected means, rationally expected. In other words, it's the probability weighted, average. In other words, you might think, when we say expected, people generally don't understand what it means. They think that's wished for. I ask the students, many times, many times I ask the students, what grade do you expect from this class? And every time I ask this, then some students say A. That student is either very, ambitious or just wishful, or just clueless, right? I mean, how can you expect A? I mean, if you have been doing well, right? I mean, every exam, every test, you got the highest score, right? And every class you never missed. You have perfect attendance. You have been doing, you've been getting high scores in every test, every homework. Then you can reasonably expect A, right? But otherwise, if you say A, then that's just wishful thinking, right? Or otherwise, you're just clueless, right? But then this is important. If your expectation is rational, right? Rationally expected, right? Why? It's based on your, past performance, and it is all factored in, right? So, and statistically, right? Suppose you are, I don't want to spend too much time on this, but in probability theory, right? In probability theory, let me go back to the whiteboard. A dice is a fair cube. Fair cube means, each number I represent, right? Isn't that right? On each side, and it's a perfect cube. And if it is a perfect cube, and there are 6 numbers on each side, and each number has the same probability, right? Isn't that right? The probability of every number, I represents individual number. Probability of all numbers are 1/6. Every number is 1/6. Isn't that right? And suppose you are playing this game where you roll a dice, and the number that comes up, right? You win the dollar amount, matching the number that comes up. So then, so in this game, you will never lose anything, but you have only something to gain, and the dollar amount you can ranges between 1 to 6, and all of those numbers have the same probability of 1/6. Isn't it right? As long as the dice is not distorted, right? If it is not a fair cube, then they would have a different probability, but they all have the same probability because it's a cube, right? Then what is the expected payoff from this game? What's the expected payoff? Okay, expected payoff it's hard to write that. Expected payoff is actually, how do you find expected payoff? Once again, people say $6. No, that's your wishful thinking. I mean, how can you reasonably think 6 will come up, right? So how do you know what's going to come up? You don't know. So you'll have to weight every possible number by their weight, right? So that means, it's going to be the sum of every number, right? Of course, the number runs from 1 to 6, right? And then you will multiply, you will weight the probability, right? You will weight every number, right? In other words, by the probability. So that is like, then it's going to be like, 1/6 times first possible payoff is $1, right? And then 1/6 times $2, and you keep going like this, that, right? And then, so we truncate the middle, right? $3, $1. So then times the last possible number is $6, right? So if you do this, this is what? This is the average, isn't it right? Weighted average, which is and then each possible outcome, $1, $2, $3, $4, they are all weighted by their probabilities. And then you will find, oh, in this case, isn't this, because 1/6 is a common factor, if you factor out over 6, isn't this simply, sum of all the numbers? $1, $2, $3 plus all the way, right? And then plus $6. Isn't that exactly how you find the simple average? Yes. If you think about it, it's exactly right. In this example, in this case, you can factor out the common factor, right? Right, which is 1/6, right? And then you sum all the numbers, right? Running from 1 through 6, right? So in this case, it's a simple average, right? So it's a special case of weighted average. Simple average is a special case of weighted average where all the weights, right? All the weights are the same, right?
All right. We are already out of time, so we'll have to call it a day here. And I want you to please save this file because we're gonna continue to work on it tomorrow. Not tomorrow, Monday. So we're gonna calculate, return and standard deviation and things like that. Don't forget the midterm starts tomorrow, right? Midterm starts tomorrow. Don't forget, please. And have a peaceful evening, and I will see you. Good luck with your midterm, and I will see you guys. And please get a head start because if you put it off until the last minute, and at the last minute, something goes wrong, there's no way I can timely fix it, right? So think about it. If you send me an email at 11:30 p.m. Sunday night, your email won't be discovered at all, right? There's no way to fix anything before the deadline. So please get a head start. Okay. All right. So that's it for today. Go in
Thank you,
peace.
Professor. Have a good night.
Or-
Did you see my message by any chance? Did you see my message
What's
by any
that?
Thank
chance?
you, Professor.
Thank you, Professor. Good night. See you next week.
Good night. Good night. Yeah, Brendan, what did you say? I'm sorry.
Did you see my message?
Yeah. I saw it. I saw it. Don't
Okay.
I said I already said don't worry about it. Okay.
Thank you so much.
All right. You're welcome. Take care, everyone. I'll see you guys on Monday. Okay. Stop recording and